Welcome back to the None of Our Businesses podcast, where we discuss the issues that really matter when it comes to running a successful enterprise. This week's guest is Suzy Oubre, who has been helping clients with credit challenges for over 22 years. She helps clients solve their cash flow issues while improving their business models. Her company, Alliance Commercial Credit Group, offers alternative financing from commercial banks.
Welcome, Suzy, and thank you so much for being here.
Thank you, Ty. My pleasure.
Yeah, let's jump right into the thick of it, and I'd love to have you tell us about Alliance Commercial Credit Group, who you serve, and what you provide in regards to all in the alternative finance space.
Okay, very good. Well, I've been working in the alternative financing space since 1995, and basically, I can help customers that do not qualify for bank financing. There's two general categories. Those are going to be new, growing companies that don't have the operating history to access a decent credit line from a bank, or it could be companies who have been longstanding and have hit a bump in the road, and they're not as profitable as they need to be, and they may have an operating line with the bank, and the bank is asking them to leave. And there is money outside of the bank that the majority of folks don't know much about. They don't teach very much about it.
Yeah, I as you mentioned, that people who are getting asked to leave by the bank, I went through that with a client a few years ago in the special assets group, and man, I wish I knew at that point. I wish I'd had this connection to kind of call you up then, because it was stressful and hairy to work through that process with the bank, and not necessarily know all the options available at that time.
It's very stressful for the customer. It's confusing since it is something that they're not familiar with. If you're starting with no background in it, it's a lot of homework. So they're having to go out, find the finance companies, what they offer, whether they'll offer it to their industry, which collateral they'll loan against. I have gone in and helped companies many times over the years, and they are very thankful when they meet me, because when you have accounts receivable, inventory, equipment, and you have commercial real estate, and you can't find any one particular finance company that'll do all of it, or they'll do parts of it, it becomes very overwhelming very fast, and it's very time consuming. And they can spend months spinning around trying to come up with a solution and not. So that's where I come in. I make it easy. Oftentimes when a bank is asking a customer to leave, sometimes we have to reshuffle parts. So we have to realign things. Maybe they need some additional capital to catch up the accounts payable, or maybe they owe some taxes, to the taxing authorities, and they need access to money to take care of those problems. And, that's what I do.
At the core of this kind of alternative financing is the concept of asset-based lending, or ABL. And I think,
yes.
If we get into to maybe a little bit of the detail of that in comparison to cash flow lending, which is what we more commonly see at the banks, can you explain to our audience how is asset-based lending different than that kind of cash flow lending that they might be?
Yeah, so it's very different. In the bank, banks typically loan you some of your own money back. Okay, so you have to have retained earnings or equity in a company, and they'll give you a portion of that. In the asset-based world, we will take the collateral value and we'll loan against that. So let's say that we're working with a company that's doing $3 million in annual sales, let's say. We will just take a percentage. It'll be a percentage advance rate against the assets that they have. So if they have accounts receivable or they have inventory, AR, the advance rate can be anywhere from 80 to 92%. So they have access to a lot more money using just the collateral and using a formula against the collateral than if they're in a bank and they have to have the retained earnings and the equity in their balance sheet. We don't care about that. We care about the collateral value. So accounts receivable, their inventory, if they have commercial real estate and they have equity in the commercial real estate, oftentimes we use that to access additional cash. It depends on what we have to pay off or pull money out, recapitalize. There's lots of flexibility in there.
It kind of answers my next question, but I'm going to go ahead and ask it if it maybe inspires to kind of elaborate a little bit on some of what you were saying there. But because my next question is, why is it that alternative-based financing options are still possible when a client otherwise is getting turned down from the bank? What is it about alternative financing that makes that possible? And I asked that I can just take it right out of what you just said, but I'll let you say it again. Yeah.
So in a collateral-based world, we can loan based on formulation, but we also check on the collateral a little. So there's kind of an audit process. We're relying on the accuracy of the billings and the creditworthiness of the customers that our customers are working with when we're making a credit decision. So basically, if the customer is a good quality customer and they pay their bills on time, we're evaluating all that information. So there's two different categories of financing that we work with, okay? Outside of a bank, you have asset-based lending, and then two steps outside is factoring, okay? And it's easy if I can explain, the simple and then next to bank financing, okay? If you go to a bank and you get a line of credit, when you step out of the bank and you get a line of credit, we're going to look at the collateral base as a whole, and there's a borrowing certificate. Sometimes there's quarterly audits or semi-annual or annual audits. That's how they verify the information that they're loaning against. Two steps out of the bank is factoring. And what they do is they're verifying the validity of the invoice. So there's lots of different ways that they can do it. There's direct notification, non-notification. There's lots of flexibility in there. But they may do an audit on the accounts receivable. So they make a call, they verify that it is truly an invoice, the product is shipped, the customer's happy with it. They do the complete back-end management of the accounts receivable for folks.
I guess to then take this from a different angle, let me ask, would a company ever have both traditional bank financing and alternative financing at the same time, or are these things mutually exclusive?
Yes, not generally. The ABL or factoring company has to have a primary position against the company receivables and assets. If a bank were involved, they would be in a primary position. So generally speaking, not. I'm going to keep it simple for our interview. There are exceptions to that I could explain in a later time. But so they would become your new financial institution. Whether it's an asset-based lender or a factor, they are your new financial institution. They are doing your lending for you and helping you in every way that a bank would. They just are not a depository institution. So they're not federally regulated, which is very important to understand the difference and why folks who are brand new startup or having problems, why the banks can't do the financing for them is because federally regulated institutions have to they have an obligation to take depositors' money and safely keep their money. So depositors put the money in the bank can't just loan the money to anybody. Otherwise, they wouldn't be protecting the depositors' money.
Right.
So when you get outside of a depository institution that's federally regulated, you step into the asset-based world, it's private money, and we don't have those regulations.
Right. Well, that's a interesting and important distinction, I think, for companies in thinking about this. Do you find, how often is it that companies that use alternative-based financing are heading for bankruptcy or otherwise going out of business? Is that most of the time, or is that really just some of the time? I mean,
it's interesting. It kind of goes along with our economical cycle. Okay, we just went through a very good long run of strong growth in the need that people would have for my kind of money is because they're growing rapidly. It's fast. The bank can't give them enough money. Their cash flow is very tight. You can't climb a mountain with no gas. So that's where we're at in our cycle today. But we are heading into, we don't know. There's a lot of unknowns that are coming. Do I think bankruptcies are going to pick up? Yes. The corona pandemic has created a world of problems for many different companies in various sectors, but it's also created incredible opportunity in other sectors. So are there going to be problematic transactions coming? Yes. Will I be able to help that or help them? It depends. It's a very complex problem.
No, I think that solves kind of perhaps a misconception for some people, is that this kind of alternative financing is not just for purely troubled companies. It's gas for growth for companies that maybe otherwise don't have access to.
Exactly. And that's the majority, is that, they go to their local bank. Let's say they're doing $3 million in sales. They go to the bank and the bank will give them a $50,000 credit facility. And that's not enough.
Mm-hmm.
Maybe they're looking or faced with the fact that they're going to grow a couple million in the next year. They're going to go from 3 million to 5 million. The bank cannot necessarily keep up with that demand. But when you're loaning against the assets, and if the accounts receivable are growing and the inventory is growing, well, so can my credit facility. So I keep up with it. And I'm not worried about the covenants and the ratios and the restrictions that a typical bank would.
I think you kind of mentioned this a couple minutes ago in talking about how the clients that you work with kind of depend on the economic cycles that we're in. And so, I'd love to hear your take on, the scenario we're in right now. We're recording this during the pandemic. We've got a fair amount of uncertainty about economic times right now. It seems like it's been good in some ways, but obviously not good for certain industries like restaurants and retail and bars and so on. So are you seeing that this kind of uncertainty creates more need for the services you provide?
Well, we are in an interesting point, okay, because the government did the PPP money. So the PPP money helped people out for a little while. What's also happening right now are the banks are restructuring a lot of loans. So let's say the customer's got a commercial real estate loan and they've taken advantage of the rules that they can be delinquent on those mortgage payments. Okay. So now the banks are tacking the delinquencies onto the back of the loan. But at some point, all of the help is going to run out. The question is when the bank's going to stop helping out. And, we're yet to see the impact of that. I think that first, second quarter next year, when the PPP money, when it starts to need to be repaid, when the customers, now they're going to have to make their mortgage payments. Well, we don't know, but next year I would anticipate that we're going to see a lot more activity. The pandemic's created great opportunity. There's no shortage of need in the transportation industry, medical suppliers, companies. We have a lot of distilleries, distilling companies in the area. They may have been approached to turn their distilling operation into hand sanitizer. Okay, so it's created an incredible opportunity for certain business sectors. And then, of course, it's been really devastating for others.
You and I had the opportunity to meet you earlier this year, and I learned, spending some time with you then, I learned things about the industry that I didn't know or have a perspective on before. And one of the things that I learned from you about ABL, again, alternative-based lending, is that really, to do that right, the company needs to have an exit strategy. That to get into ABL, you need an exit strategy from it. And so I want to ask about that. What if there is a typical exit strategy that you see, or if there are example exit strategies that you can kind of tell us about how that works for companies that are thinking about getting started with alternative-based lending?
Yes, anytime, and it depends on the scenario. So let's take a company who is being asked to leave a bank, but they're not profitable. And so the bank's asking them to go find an asset-based lender. An asset-based lender costs more money than bank money. So obviously, if you're going to go into a higher cost of funds, you're going to have to come up with a plan of how you're going to get out of this. Okay, and that plan is going to be getting the company back to profitability in that scenario. We have to make sure that they use the money for the proper things, meaning you can't use your new capital to do any kind of capital expenditures. I've seen this happen a number of times. Somebody will get new money and they put it into leasehold improvements. Okay, so we just have to make sure that the money is used correctly, that it's used for cash flow, inventory, payroll, sales increase. And then, of course, we have to work on the profitability of the company. We have to make sure that they can afford the higher cost of funds. That is that situation. And for other companies, if they are in a steep growth pattern, let's say they are doubling or tripling in the size of the operation, asset-based financing and factoring are an amazing tool for doubling or quadrupling the size of an operation. It's a great tool. At the point the sales plateau to, let's say, they're back to a normal 10 to 15% annual increase in sales, that would be the time that they would be a very good fit for traditional financing with a bank.
Thank you for that. I think that, I think that gives kind of a great overview for our audience to think about in terms of when alternative financing is an option, when to think about it. And of course, if they've got questions on that, they're not sure, there's folks like you they can reach out to, right? To start having those conversations. Yeah.
Anytime I could answer any questions. But just to make it very simple, from a formula standpoint, if somebody can access 80 to 90% advance rate against their accounts receivable and up to 50% of their inventory and up to 60% of the liquidated value of their equipment, these formulas, they have to look at the situation that they're in. If they are with conforming financing from a bank and they are suffocating and not able to keep up with stuff, they just don't have sufficient cash flow, and they are starting to borrow money from their vendors, or they're borrowing money worse off from the taxing authorities, whatever, they're borrowing money from themselves, they're racking up their credit cards because they don't have enough cash flow. Those are the folks who need to be making some phone calls. Frequent overdrafts with the bank. They will pay so much more in fees, than they would with an alternative lender.
Mm-hmm. I'd like to kind of pivot to talking about, the fact that in providing this service, you're a business yourself, and you've kind of grown into this profession. And I'd like to ask a little bit about that, maybe have you tell us about your background and how you became the principal of Alliance Commercial Credit Group.
Well, that would be a very long story. So in 1995, I took some special training and learned how to be a broker for factoring receivables. That is where it started in 1995. I had made a career change. So my prior career is in the healthcare profession. I'm in direct patient healthcare. I still am. That was my original training out of high school. And at some point, I decided that I couldn't make enough money. How was I going to send my kids to college? I was dependent on joint income. I made a personal choice to do something different. And so I went through this training program, and really my education started at the point that I got my business cards made. So I've always worked for myself. I never worked for another company. I got a little bit of training. I got my business cards made, and I went out and I started marketing for companies that needed factoring. And along the lines, I was basically taken under the wing of some presidents of finance companies who were excellent teachers and continued to mentor me for many years. I've had terrific mentors, several. So I worked in the factoring space for about 3.5 years. And then once I started really understanding it, I started to realize that I'm doing the same package, whether it's for a small company or a big company. Then I started realizing, well, hey, I can do equipment loans. Well, no, I can do commercial real estate loans. Well, I can do inventory financing. So over a very long time, I started building my network of resources, of capital. Depending on what asset I had to work with, I had money for that asset. In whatever business sector, whether it was medical receivables, construction receivables. When I started in 1995, 98% of my portfolio were contractors, because at that point, that's who needed the money and that's who wasn't being served in our marketplace here. So that was my entry into it, even though everybody said, don't do construction, don't do medical, don't do construction. Basically, I did anything that needed to be done. I figured it out. So it started with factoring. It grew. The typical size of the transaction grew. That's just a natural progression in the industry. So, I started with $150,000 loan requests, and today the average size loan request is 1.5 to 5 million. And it's the complexity of it is more, but I learned a lot from these wonderful teachers that took me under their wing and mentored me for a long time. And that's truly what happened. That's my story. And
well, it's the story of an entrepreneur, and I think that it's an interesting career that I think a lot of people could be interested in. You're helping other businesses, bringing solutions to the table that provide gas to the growth of these other businesses. You get to learn a lot about different businesses and think about what it takes to help them survive and what it takes for them to thrive and so on.
It's been incredible, Ty. I have toured all different types of companies over the years. I have, precision milling companies. I did financing for a braces manufacturer. Never seen so much inventory in a very small space. I've done every sector of construction over the years, subcontracting of every kind, transportation companies. So it's been wonderful. I've gotten to tour all different types of companies.
So given the environment that your business operates in today and what this profession has turned out to be for you, what would you recommend to somebody else who might be looking at this as a potential career path for themselves?
Let me tell you, it takes an incredible amount of perseverance, drive, and dedication. You have to be a driver-driven type personality. If you aren't that way, you probably won't be very successful at it.
Yeah, I think that's great advice probably for most businesses, right? If you're going to operate your own, I think that advice for sure carries over.
Yeah, if you're an entrepreneur and you have your own company, you are very driven. You have to be. I'm the only one that's going to take care of me. Right. I'm the only one that's going to take care of my retirement, my future. There's a great deal of responsibility. I'm creating the sale. I'm closing the sale. I'm not going to eat if I don't produce.
Right.
It's not for the faint at heart, for sure.
Well, with that, is there anything that I could have asked but I didn't that you'd like our audience to think about?
Now, we didn't talk anything about real estate.
We didn't.
Different. The requirements are a little different for commercial real estate. It's still an important aspect to restructuring debt. That, let's say that a customer owns some investment properties themselves. Maybe they have an apartment complex, or if it is owner occupied, they own their building and they have good equity in the building. Anybody that owns real estate probably at some point in their life may understand what illiquid means. And illiquid means you have equity, but you can't get to it, which is very frustrating. So folks can have some very, very valuable real estate and they can't access their equity. Because why? Because there's a story. Something's happened. Bad credit, divorce, company didn't do so good the last couple years, so they can't show the profit. They're self-employed. They didn't show the money on their tax return. Restaurant owners are really good about that. They don't show the income. Okay, well, that's good for taxes, but not good when you go to borrow money. So in the real estate arena of bridge money is outside of a bank. We're going to look at the property value, and we will go up to 65% loan to value as long as I can prove debt service. So I do have to show that they can make the payment. But if I can access the equity that they need to take care of problems. Let's say somebody borrowed a bunch of money on their credit cards for their operation, for their company, or they did improvements to their apartment complex on their credit cards. And then they thought, well, I'll just go refinance and pay my credit cards off. Well, now their credit card, their debt to equity is so far off, the bank won't give them any money because they owe all the credit card debt. It doesn't matter that they put it into the apartment complex. It doesn't matter that they put it into the company. But we can access the equity outside of the bank world. We can access that equity as long as up to 65% produces the cash that they need to pay off their problems, taxing authorities, credit card debt, accounts payable. I don't care what they use it for, as long as we're shuffling the parts around. We're just shuffling them around. We're righting the wrong. We're making them look pretty on paper, so that in 9 months or 12 months, they can go back into a bank and get bank financed.
I see.
That's a very important piece of the asset-based puzzle.
So the exit plan with those kind of real estate deals is to get them stabilized and then move them towards back towards bank financing.
Or back to a mortgage company, bank. There's all sorts of programs.
Mm-hmm.
I have 7(a) programs. I've got non-depository institutions that do 7(a) money. So you're not required to have a banking relationship at that bank in order to get the money. So there's so many opportunities, but that's a really important piece of the puzzle, especially looking into this coming year, because I'm not sure what's going to happen. There's a lot of things going on out there, and I don't know how it's going to impact, the restaurateurs, all the commercial space. Everybody's working from Zoom. How is this going to affect the commercial real estate market in the next year? Or the restaurant's going to be closing. More restaurants are probably going to be closing.
Mm-hmm.
Since they're shutting down again. Washington State, they're shutting down for 4 weeks.
Mm-hmm.
Just don't know how people are going to survive, but that's going to create other needs in the future.
Well, that's fantastic information. Thank you.
I'll just say that, in college today and in high school and even in MBA degrees, they spend very little time on alternative financing. There's very little information about it. There's a lot to know. There's a lot of misunderstandings about it. But it is an incredible tool. That is what it is. You plan accordingly. And it's been a fun experience working in this space. It's been a great experience. So there's just so much to know about it. I wish I could tell and educate people about how it works, and how they can use it to better their business and not be afraid of something that they don't know. Even a lot of the banks, they know a lot more today than they did. Yeah. When it started in 1995, they didn't really know hardly anything about it. So they have gained incredible knowledge over the last 25 years. They have a better understanding, but I think they still miss incredible chances to help companies grow. They miss it. Or they'll see a situation and they'll think, nobody's going to do this. This is a train wreck. No one is going to do it. But there really is ways to do it. And so those folks get unassisted, basically, which is, and there's one of me, and how do you get the education out there? This is why we're talking today. I would hope that that people if they have questions, want to call, ask them questions, I'm here.
That's great. Yeah, I think I would encourage everyone to reach out and get those questions. I always say entrepreneurs, the best entrepreneurs like having options, right? And this is another set of options that may not have been explored. So, reach out, contact Suzy. She'll, I'm sure, be more than happy to talk to you and help you understand those options so that you can make the best and optimal decisions for your business.
Thank you very much, Ty.
Well, thank you, everybody. And we will see you in our future episode. Take care.